Well, good morning and welcome back to the Money Advantage podcast. Today we're talking about what to do with a windfall. Now, this was a listener question, but probably something that is top of mind for you if you're in a situation where you either have received or plan to receive a large infusion of cash or capital. This could be the sale of a business, the sale of a property. This could be an inheritance that you're receiving, or the potential for any one of those type of things to be imminent in your future. And you're thinking, if you're already in the infinite banking space and you're using infinite banking, you might be saying to yourself, how do I best put this capital into an infinite banking policy? And that's what we're addressing today because we had a listener asking this very question. So we're really excited to bring this conversation to you today and really talk about what to do with that windfall, how to fund or capitalize a policy. And certainly I want to start this whole conversation by saying it depends, and it's probably going to be something that comes up on the conversation a lot today. It depends on your goals. It depends on your financial picture. It depends on a lot of factors, but you may be saying, how do I put this capital to work inside of infinite banking as quickly as possible? And we're going to be able to really talk through the pros and cons of how to capitalize a policy, whether you're paying over time or you're doing a 7-pay or a 10-pay or having a premium deposit fund. We're going to address all of these questions today on this podcast. So thank you so much, Bruce, for being willing to have this conversation that I think is really crucial to understanding how to make infinite banking work well for you.
Yeah, this does come, excuse me, this does come up quite often as a question. And it's a very, and I think depends is a great word to use. The big thing that you have to worry about is many people say, well, can I design a policy so that it can hold a windfall when it comes in, but I don't know when it's going to come in? The bottom line is the answer is yes. However, in most cases, I don't think you want to do that. And the reason for that is because of the modified endowment contract law. And let's think about this as our associate Becca Wilhite has so beautifully depicted in one of her booklets. Is if you think about a specially designed whole life insurance contract that has infinite banking process in mind when you design it, you need to think of the base policy being part of the hull of a sailboat. And then in order in order to put additional funds into that sailboat, you can raise up the life insurance by using a term rider. And that would be like the mast of the ship. And then the mast would be adding, you would add mast all the time as far as PUAs go. And I'm sorry, you're not adding mast. Well, you could add mast, but I'm actually talking about sails. You're adding sails as far as PUAs go.
Mm-hmm.
And if you get the term rider too large, that mast gets a lot bigger relative to the base of that sailboat.
Oh, yes.
And it doesn't mean it's going to tip over and become a mech, but it sure in the heck has a better possibility. So the higher you put term riders on relative to the base, you make the contract more unstable. Doesn't mean it's not going to work, but it does mean it makes it a lot more stable if you have that vision in your mind.
So you
The
mean
second part,
bigger base for more stability, not too tall of a PUA or too much PUA that's going to make it more unstable.
too much of a term,
Term. Okay.
okay, too much of a term, because what'll happen is as you add the PUAs, just like if you add sails to a big mask, it has a potential to fall over and thus won't be very efficient. So think of it this way: in order to have a windfall and not have it mech the policy, you have to have a lot of term that you're not actually using along the way. So that also makes it efficient. Visualize this, listeners, as a sailboat. The hull is the base. You have to put a big mast on it, and now you only have some sails at the bottom. And those sails at the bottom represent your PUA, but the additional mast above the PUAs actually still make it top heavy and can actually have it fall over, make it inefficient. So that's what happens when you design a policy so that you can have windfalls in the future. You actually are taking and making it can work like that, but you're making it more inefficient if cash value is your only goal early on in the policy. So I hope that visualization was good on the podcast so that people can understand. And we can go into some other examples, but I wanted to establish that the reason that you can design policies for windfalls, but the reason you may not want to do that is the term rider may become so large that it will not make the contract efficient as you might want it to be early in the contract.
So, Bruce, that is a one piece of the question I hadn't even considered, is the idea of designing a policy before the windfall comes for an idea of a future windfall. So you're saying, let's make sure you're not designing with too much capability of putting in a lot of extra money because you're going to run into that mech problem. I can think of two other situations where you can be in a situation, be in an environment where you might want to dump a huge infusion of cash. And one could be you have a policy, but there are a lot of loans outstanding. So that would be a situation where you have the ability then to take a windfall, or depending on how large that is in comparison to your policy loans, perhaps paying off policy loans would be a good move. Perhaps capitalizing a new policy would be a good move. And then in addition, would you want to put capital somewhere and hold it to do a short pay, a 10 pay or a 7 pay, as opposed to a longer pay policy? So let's go ahead and kind of break that down into a couple of different buckets instead of trying to address it all at once. What would you say, Bruce, about the idea of saying, I have outstanding loans right now. Should I think about first paying off those loans or capitalizing a new policy? How would you go about thinking through the pros and cons of doing that?
Well, I think that's one of the nicest places to use a windfall is to pay off policy loans. Frankly, you could do that and then give yourself some breathing room to decide whether you want to then start another policy by using the capital within that policy. It's not ideal, but it would be give you some time to think about it. Really, what it comes down to is you have to ask yourself on the next policy, are you going to be able to fund it properly uh, going forward, not just with the windfall? Because let's say it's a $200,000 windfall and you want to think long range and capitalize the policy as long as possible. And there are also some of the carriers say you cannot fund PUAs after a certain time period, so on and so forth. So all that has to be figured in. But let's say you have a $200,000 windfall and you want to get that money into a policy. Having a short pay really puts some pressures on the policy. Also, is about how much term you would put on there. And then the term, you don't want to put a lot of term on there if you're not going to use it, because then it drags the policy down as far as the cost. And also, we're kind of violating Nelson's rule of thinking long term. Now, that doesn't mean that there are not situations where you want to short pay a policy, such as we had a client just the other day that's 65 years old and wants to um, only fund a policy for 10 years because he is doing some transition from qualified money to tax free, and it'll be gone in 10 years, and he doesn't know where additional funds would come from. And
Mm.
so we have to look at whether a 10 pay is more efficient than doing maybe a 30 pay, but then RPUing, reduce paid
Reduce
up.
pay.
If our
Mhm.
listeners don't understand that, reduce paid up, which is in the contract you can do, which is simply means you can stop paying after 10 years, even though you have the ability to pay up to 30 years. So all that has to be figured out also with now as you get older and you have windfalls, you may also be trying to determine how much death benefit you actually want. I was actually with a conference yesterday, conference call, and we were talking about the older you get, you're going to have more likelihood of windfalls from
Mhm.
sale of real estate, from business that you sell, from inheritances. And it's just it corresponds with the fact that as you get older, the death benefit actually becomes more important to you. And I was joking around with some of the younger people that have been in the business for a good time, even though they're in their mid 30s, they've been in the business for 10 years. And I say, I know you think you believe that death benefit is important to you at age 35 because you're in the business, but in another 25 years, it will become reality for you. And you will know that death benefit is important to you.
Mhm.
So all those have to be a factor in the design. And the final one that pops out all the time is to use your whole life contract as part of your human life value and then get a convertible term policy that you can cut off pieces of the death benefit whenever you have these windfalls and start another policy and protect your health at the time that you do application and not wait until down the road when you might get a windfall and then not be healthy anymore. So those are scenarios I think we can elaborate on.
Yes, I think what's really interesting about that last one you just brought up, Bruce, is that anyone can prepare themselves for the capability of capitalizing new policies with windfalls if they start young by recognizing human life value, which is usually a factor much greater than you would imagine. The amount of death benefit that the insurance company stakes on your life and says your life is this valuable and we would pay this dollar sum if you lost your life is usually much higher than people would intuitively um, calculate for themselves. And so what that means is the insurance company is willing to place a certain death benefit on you based on your income, your age, your life expectancy, and that's all a factor of what the expectation or the standard, the average person in your situation is likely to accomplish financially for the rest of their life. And they're paying for that. The economic value that would be lost if your life was taken early, the lost value to your family and your loved ones. And so when you use that full dollar amount to say, how do I get as much death benefit as possible? You will never be overinsured. The insurance company is not going to value your life at $400 million if your income is such that they might have a cap of 3 million on your life. So you can only get as much death benefit as the insurance company says is the maximum available for you. And in that position, you can obtain that insurance by exactly, Bruce, what you said, getting the term life insurance to supplement or add on top of the death benefit that you're getting in your infinite banking policy. So you're doing the whole life insurance and you're adding on that term or convertible term more specifically that can be converted in chunks over to whole life insurance. That is the strategy that my husband Lucas and I have used, and that's the strategy that I think is one of the most feasible for locking in your ability to use those windfalls in a productive manner. But Bruce, let's talk about this. So let's just say somebody has come into a windfall of, let's say it's a million. How would you first go about thinking about that capital? And clearly we don't usually put that straight into a policy as a single premium contract. So it's going to be spread over a time period. How do you normally think about or begin that conversation to figure out how you would put that into a policy? Would you think about a premium deposit fund, or would you think about capitalizing with cash flow plus the windfall? How do you normally go about arriving at a premium and a time period for paying in that makes sense comparative to that windfall?
Yeah, so it begins with just a heck of a lot of questions of what the person's trying to accomplish and what they're thinking about going down the road. Think about this too: is windfalls come about in a variety of different ways. So one of the ways that they come about is just an event.
Mhm.
Another way windfalls come about is actually getting a dependence off your payroll.
Mhm.
And so this has come up on an occasion where you say, okay, you got this windfall. We can design this to do 50,000 a year for 20 years or 100,000 a year for 10 years. But then in 10 years, all three of your children are going to be out of the house. How much do you think you're going to be able to continue to save then? And then we can continue the policy with that. Also
So basically
asking is
using the windfall as a jumpstart or an initial capitalization with the trailing funding coming from another source is what you're saying.
correct. And then also just talking to them about the possibility of maybe they have an investment opportunity, a cash flowing investment opportunity they want to do right now, and they have the opportunity. Remember, Nelson always said that opportunities find cash,
Mm-hmm.
and so they're hyper sensitive to that. Well, then they might say, I need all of mine, but I really don't want to lose the lost opportunity cost of putting it into a policy. And that's where you get all these crazy things that people talk about on the internet about having really skinny bases and really big PUAs. Because look, I can now make money in two places because I'm placing it in the contract. I'm immediately borrowing money against the contract in 30 days. And now look how smart I am. I'm making money in the contract and I'm making money in the investment. However, when people say that, they say it out of ignorance because although what they say is true, they are making money in the contract, but the PUA is actually paying very, very, very small dividends at the beginning of the contract. Very small. Less than 10% of your total dividend is coming from the PUAs. So
Which
then to
means,
actually,
which means what Bruce is saying, the other part of that is most of your dividends are paid by the base policy, which again is that whole of the sailboat, the main component, the main policy, the base policy.
yeah. And so now what you're saying is, okay, I got a really small hole. I have to put a really big mask on this really small hole, put this great big sail on it. Okay, so right away, even that makes it unstable. But now we're going to take that sail off of it again, and we are going to go put that sail somewhere else to make money. But that policy now, if you don't put more sails, it's just going to sit in the middle of the ocean and it's going to be affected by different waves and it's not going to be very efficient. It's not going to be able to move. Why? Because now you actually have to pay an interest to the policy that compounds. It's calculated simply, but if you do not pay it, it compounds. That's another myth you get across the internet.
So
And
I'm going to clarify that really quick. So what that
okay,
means, when you take a policy loan, you're borrowing the insurance company's money. You're borrowing against your cash value. You're not actually taking your cash value out. And what that means is you're not paying interest to yourself. You're paying interest to the insurance company. Now, that's not a bad thing. It's a great thing to pay interest to the insurance company because their overall profitability then returns to you in the form of dividend payout when they have profitability in the company, they're stable, they're strong, and they're distributing dividends to their shareholders, which are you, the policy owner in a mutual company. I know that sounds a little confusing, but that's correcting the misnomer. You're not paying interest to yourself, and there will be interest charged. It's to the insurance company.
yeah, and we've done this before in other podcasts. You can, if you set it up with the PUAs, you can pay additional PUAs later on, which is what some people call paying interest yourself. Not only some people, Nelson Nash called it this,
Mm-hmm.
but Nelson was just saying you're buying more PUAs. That's all he was saying. Okay, so when that happens, then I would suggest you not even do a policy at the very beginning. Go buy your cash flowing investment and then use the cash flow. If you got a $1 million cash flowing investment, you might be able to produce 50, 60, 70, $80,000 a year from that cash flowing investment. Then take that cash flow and fund your policy every year. So that's another technique for windfalls. And then you mentioned another one that I used to be really high on, and we have a couple clients that do it. Is you could fund a policy and then put the remaining into the PDF, the premium deposit fund. And for our listeners, the premium deposit fund is a fund at the life insurance company outside of your contract that works like a savings account at a bank. So it's going to gain interest, but that interest is going to be taxable because it's outside the contract. And then the idea is it's called a premium deposit fund. You're putting future premiums in this fund. And right now, that premium deposit fund, depending on which carrier, is paying anywhere between 3.5% and 5%. So it's not a bad return. However, the problem with those funds now is that many of the carriers have changed them. Is if you ever ask for that money back and you don't use it for the premium for the next year, they actually close the rider. So a lot of people don't want that to happen because they might want to use it for sure sometimes. So if you overfund it, and they also put limitations on how much you can put in the premium deposit fund.
So
Usually
it's
it's
like
no
a
more
waiting
than
room. It's like a waiting room to get on
right.
the roller coaster, but once you get in that room, you can't really turn around and get back out. That's basically what it's saying.
Well, yeah, you can go back out from the roller coaster, but then they don't let you ride the roller coaster ever again.
Yeah.
So, so that it's not really that viable of an option for windfalls. So, I would say the one to answer your question about how do we go about designing a lot of questions. Usually, we are looking at a shorter pay, uh, but with the idea that you're going to continue to work, you're going to continue to be a producer in your life, and you're going to be able to fund some of the policy beyond whatever that shorter pay was 7, 8, 9, 10, 15 years. And then also, we encourage maybe a family member that's going to be a beneficiary that maybe they now pick it up and start funding it.
Mm.
So, which I've done with my own father. So, this is
Which
all of these are techniques that we have used.
which would be really powerful in a family banking situation where you have the capital that is accessible to family members through a mechanism of controls. So they can access capital inside of the policy or system of policies within the family if they meet certain criteria or they are accessing it for a business endeavor or an investment, or they have a business mentor. You set the criteria for that if you're the policy owner. And then if you're in a situation where you're adding additional policies and you have a whole system of policies, there can be additional family members, like you said, that the policies are on them. So you might have 3 policies on yourself and 2 on your son and 3 on your wife, and you have the system of policies now that family members can access and use according to whatever guidelines you specify in your family banking process. So maybe this wasn't a pros and cons episode as much as it was an options podcast for what you can do. There are many options for you to use a windfall and to think about how you want to obtain your financial goals with that capital that you have and the multiple options to arrive at a good outcome depending on your financial picture and depending on your goals. Bruce, is there
Yeah, I
anything
think
else
that
you want to add? Go ahead.
I would say the default thinking, the default thinking would be to get your human life value up as high as possible if you anticipate. Now we have a couple clients uh, that get stock options. They don't know when they're going to get them, but they get stock options. And so those clients know that probably they're going to want to start another policy. So having a separate term is good. we haven't even talked about this. Once a policy matures past 7, 10, 15, 20 years, now you may even be able to take part of the term rider off that policy, not the entire, but part of it off. It may even drop down where you can only do the base amount in that policy. However, now you can automatically convert the term rider within that contract to another contract and start a whole nother contract there. So you don't have a standalone term. You use the appropriate amount of term from your original contract. Now, yes, you're probably going to have to, or you can not only put a certain amount in the original policy, but what I found over my career is that term rider, when it converts, you can put even more than what the original amount was in the first policy. So the total amount of premium goes up, and thus you're saving more capital.
Mm-hmm.
So that's also another possibility, as long as it's a seasoned policy. We're talking a minimum of 7 years, probably more like 10 or 15 years to look at that as a possibility.
So many great ideas. I love to engage with our listeners on the podcast. We're about to close here. If you have any final questions on any one of the ideas or topics that we've mentioned, and you pop that question in before we close out the show in a couple minutes, then we'll try to answer that. If not, we can use those questions to be able to determine the course of future episodes, because questions like this are on so many people's minds. And as you are living your life and getting started with infinite banking or just making financial decisions, you're going to encounter things like what we've addressed today that will come up on your radar, and you will say, now that I have this new philosophy, how do I navigate this particular circumstance in my life? How do I solve this particular problem? And as you are continuing on the path of building financial freedom, you're going to create new problems to solve. And I don't mean that in a bad way. What I mean is that as you expand and grow your capital, you're going to have different set of circumstances, different things to solve. And I mean a problem like a math problem. When you are 2 years old, your math problems might be saying 1, 2, 3. When you are in sixth grade, your math problem is more like pre-algebra. The problems that you're solving are expanded because you have new capabilities. And that's the same way that new problems and bigger things that need bigger solutions will occur in your financial life. So Bruce, I see that we have
Yeah, before we get
something.
to Fritz, Fritz is our great listener, and he always asks great questions. And I'll get to this in a minute, Fritz. But um, I want to talk a little bit about what I've seen detrimental when people are trying to design policies for windfalls. And that is what we've earlier talked about, was the skinny based policy with a lot of PUA. Because according to the MEC laws, in order to do that, I think we've expounded on this on many podcasts, you have to have a lot of death benefit. And you do that by doing a term rider on it. Well, what I found is that causes the overall death benefit to go up. And now we actually have two clients that have come to us from other advisors that they did this with, and they hit their human life value. And you might think, well, Bruce, you just said that's a good thing. However, they hit their human life value mainly with term early in the policies. One was at 3 years, one was at 7 years, and now they had a windfall, and they could not even get another term policy or another whole life policy because they've already hit their human life value.
And
And they
because
could
they didn't hit that 10, 15-year mark where you have the ability to
correct.
reduce the term inside that policy and capitalize a new policy. So if that policy had been more tenured, they might not have been stuck in the same situation. Is that correct?
Correct. And one of them, that's what happened to one of them. They were wanting to remove the term to start another one, but when they did that, it actually met the policy.
Mm.
So that wasn't a solution. So that's another real problem with skinny based policies, because in order to put those huge PUAs in, you have to have a lot of term in the contract, and it eats up your human life value. And once again, I know it sounds contradictory, but if you follow the logic, is then you cannot actually have more. Now you can have more if that um, windfall increases your net worth enough
Sure.
to now your net worth allows you to have more room. But normally with these ones I just recently saw, we could not convert those terms because it was going to mech the policy. So Fritz was asking, I believe, he says the new policies are revised. Says what are the reasons an actuary would revise when the cash value starts based on experience? For example, it starts a year earlier, meaning the new policies are revised. I I'm I'm not really sure what you're asking, Fritz. I think you might be asking that when the term rider comes off either partially or whole, why the actuaries are then saying how much you can put into the original policy and how much you put into the other policy. First of all, the new policy are already established because your health is established. So they're just going to use actuarial tables for that. The other one, they're going to look at the performance of the policy and actually how you funded the policy. So, did you fill your PUAs up? Did your dividends perform the way they thought they were going to perform and buy the amount of insurance that they thought they were going to buy? It's interesting because a lot of people don't know this, including agents, which drives me crazy. But when we talk about the base policy, the cost of the insurance is static or stays the same for the entire contract. However, PUAs, you're actually paying an additional cost of the insurance every year that you buy PUAs. Why is that? Because they're optional. So the actuaries don't know when you're going to buy and when you're not going to buy. So they actually have to do it on the cost of the insurance of how old you are. So if you
Hmm.
backfill the policies at a certain age, that when I say backfill, what I mean is you're catching up on PUAs that you did not pay from previous years, and there's catch up rules on that also. Then you're actually purchasing insurance at an older age when if you would have purchased the PUAs at the time you originally thought you were going to, you would have bought more death benefits.
Mm.
There's a lot of moving parts in that. So then they do all the calculation. They see, and frankly, when you pay your policy originally, because the policies are designed that you're always making your premium payments on the date that they are due. And I'm telling you, people don't do that. People don't pay their policies for 30 days, sometimes even outside the grace period, which you're saying, well, how can they pay outside the grace period? Well, if they have enough cash value, the cash value covers the grace period. Then they actually pay after the grace period. Well, all that affects the dividends that are paid out, the cash value, the death benefit, all those the actuaries take into account after you take the term off completely or partially to start another policy. Probably a lot more than people wanted to hear
Probably
on
a
this
little
podcast.
deep, but at the same time, it depends on what you're coming for. I know we have a lot of agents who listen in to the show and are learning from this. There's also a lot of people who want to know the nitty gritty and all the details for exactly what's happening inside a policy. I think the big picture is to remember the reason why you're putting money into an infinite banking policy in the first place is that you're storing capital that's accessible and usable, and that capital is growing with uninterrupted compounding regardless of whether you have a policy loan out against it or not. And the idea of being able to store capital and access it without interrupting the compounding is powerful. And it's so powerful that when you get past the initial period of whether you call it lack of liquidity or whether you recognize that you've paid in a certain dollar amount in premium and you don't quite have that much available in cash value to borrow against, when you cross over that threshold and all of a sudden your cash value is higher than anything you've paid in and your dividends are now higher than what you would get on another investment, and again I'm not comparing it life insurance to an investment, but when you realize the dividends are growing beyond what you would have funded into the policy, you have a lot of opportunity for powerful growth in the future. And if you get started, some of these nuances will become more apparent and clear to you, and some of them are not even that necessary to be able to use the policy and use it really well. So it depends on how much you want to dig into the weeds, but somebody can very successfully use infinite banking without getting bogged down in all of the weeds as well.
Yeah, yeah. So, hey, we have some great listener questions. The Hoop Scoop says, I asked my former advisor about converting the term rider on my existing policy, and they said it would mech the policy. Presently, the policy is 4 years old and has a $600,000 term rider. And it is they say 80-20. Once again, I'm on a crusade to make sure everybody's saying the base first. So I presume it's a 2080 policy. So Hoop Scoop, because it's only a 4 year policy, that's a big part of the problem because you have not gotten enough seasoning where the dividends are buying more, paid up additional insurance, so on and so forth. And frankly, because it's only got a 20% base, it's if you use my sailboat example again, they had to put so much term rider on there. It's like that big tall mask. It's not as efficient as far as um, being able to produce dividends to buy more paid up additions early in the policy. And thus, I'm sure your agent's correct because just from experience, you may be able to convert a little bit of that term. However, it also depends on the carrier. So the carrier we actually work with, for the most part, we have three carriers that we work with, but the one we work with the most, they actually have a mech limit and they don't even allow you to get up to the mech limit. So they're working a little wiggle room in there. We have another carrier that they will actually have the mech limit slightly below your premium because their interpretation of the law is that's never going to happen anyway. Well, unfortunately, I've seen it happen because what they were believed that they were going to, their dividends were going to perform so well that they were going to either buy out the term or they were have a term rider, a standalone term rider, not a standalone, but a term rider without a blended situation that would actually um, be able to hold up the sailboat, but without making it too top heavy. And so that's what you actually have to understand is the smaller the base, the more fragile these contracts are. Doesn't mean they won't work, but the more fragile they are. It hit me the other day at the Nelson Nuggets, which is a monthly meeting we have with all the authorized practitioners, is this is the same thing. This policy design is the same thing as what people try to do with universal life policies, whether it's a traditional UL, whether it's a variable universal life, or whether it's an index universal life. Because what they say on those is we are going to pull the insurance down so much that we're going to minimally pay it like this minimum base, and then the index, the stock market, or the interest that we make on this is going to be able to pay the rest of it. And that's why they're so fragile because they don't have enough premium. Well,
So
when you have
depending on
enough,
otherwise funding besides premium, everything else,
correct,
where you're saying if you have a higher base policy or more base, then more of the growth is dependent on the premium capitalization.
correct. And so that's why if you have the base policy larger, a lot of people think you have less flexibility, and you might have less flexibility in the just the first couple of years, 3, 4, 5. It's going to get really close to having more flexibility, but it makes your contract rock solid, and you actually have more flexibility in the future. Fritz actually is restating this question. He says, so in essence, I'm asking what developments would lead the actuary to make such a decision based on your experience? Well, Fritz, I'm going to tell you right now that actuarial science is way over my head as far as mathematically. So I'm going to have to talk about this actually more qualitatively than quantitatively. So dividends not performing the way they thought they were originally in the contract would be one. Excuse me. I already mentioned a couple of others. You did not pay your PUAs all the way you thought, or you paid them at different times, and then finally the the design of the base is going to make that fragile again. Now the actuarial science of the statistics on this, and also depends from one carrier to the next, how they actually get how close they get to that MEC limit, and how close they want to get to it in the future, because they do have policy changes. I don't mean policies changes within that particular contract, but if you do start another contract with the term, then that new contract would actually have different contractual language than the first contract, potentially. So all those things could happen qualitatively.
I think this has been an excellent conversation today, and just judging by the engagement and the number of people that we see listening and watching live as well, I hope that this has been really informative for you as you're making decisions about funding a current policy or thinking about funding consecutive policies in your infinite banking system, or thinking about the ability to add additional policies in the future. So this is a conceptual conversation today where we're not giving specific advice because we don't know your situation or what your goals are or your full financial picture. So if you have specific questions for you, the next best step is to go to themoneyadvantage.com, click on the calendar, and book a call with an advisor. The reason to do that is to engage in a conversation about your specific situation and figure out how to apply these ideas and principles and potential strategies to select the right one with the right policy design, with the right insurance company that is going to accomplish your goals most effectively. So we invite you to do that. And again, that's at themoneyadvantage.com. I want to say thank you for listening in today. Please continue to ask your questions. If you are not listening live and you are watching this show after the fact, we would love to hear your questions about anything that we've addressed today. There were so many conversation topics and points that came up that were not on our main bullet list. And so there are probably hundreds of questions that could be asked on anything that we have covered today. And we invite those questions specifically as it relates to how you make decisions in your financial life. So Bruce, anything before we wrap?
Oh, I just think once again, I think if people understood the value of base portion of the policy, it gives you a lot more flexibility. But we hear the same mantra over and over and over. Oh, the only reason people want you to do more base is because they're going to get paid more. We do get paid more. However, you actually get a benefit from it being less fragile. And then the final thing I tell people, if you come to me and you want to do a 10% base, 90% PUAs, I'd say I just don't want to do that. And I actually gave a person the advice just the other day. I said, go do your real estate deal, come back with the cash flow, and we'll do a policy then. So I'm actually giving up commission by having that. So is it really about commission, or is it about doing what's right for the client so that we protect them not only from themselves, but from the possibility of changes in the future?
Which is
So
going
that's
to
really
happen, which are going to happen.
right,
However,
right.
grammatically, we need to put that. Changes will happen for sure. And there is no way to guarantee exactly that you know what's going to happen in your future. And so, yes, the ability to have as many options and as many moves to make on that chessboard of your financial life, no matter what the other player, whatever life throws at you, is the ideal situation for you. So, Fritz, the mission over commission. There we go. All right. Thank you all for being here today. Blessings to you in your life, and we look forward to talking with you next time on the Money Advantage podcast. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.